Hi everyone. Perhaps you heard the phrases the bulls are in control or the market looks bearish or something of that sort. But what does the term bulls or bears really mean? Well, before we can answer the question, let's first understand price movement in the stock market. There are three possible ways in which a stock price can go: up, down, or sideways. But what actually drives the stock prices in one direction or the other? Well, simply put, it is a game of supply and demand. If the demand for a certain stock is higher than the supply, that means a lot of people want to buy the stock. This will in turn cause the traders who actually own the stock or the sellers to hold onto their shares and ask for a higher and higher price. And if the buyers are willing to pay this higher premium, then the stock price moves up. This can be seen in this area of the chart. Conversely, if the supply is more than the demand, then not many people are interested in buying the stock, and traders who already own it are willing to compromise and offer their shares at a discounted price in order to attract buyers and get rid of their shares. Well, this causes the prices to go down as depicted in this area. Lastly, if it is a tug of war between buyers and sellers, then the price moves sideways and goes nowhere. In this case, there is an equilibrium between supply and demand, causing some sort of stability in the stock price. This equilibrium state also appears at the top and bottom of the moves before the reversal occurs. Generally speaking, a trader can have one of two positions, either a buyer or a seller. A trader who buys a stock has a positive view on how prices will go. He believes the stock price will continue to head up and that he could later sell at a higher price, generating profit on his trade. This is referred to as a bullish sentiment, and the term bull is associated with him. Now, you may be wondering, why do we use the term bull? Well, this is simply because bulls charge in a low to high manner, as can be seen in the animated picture. They attack in an upward thrust, just like a trading bull buys low and sells high. The action of buying low and planning to sell high is referred to as going long. So bulls go long. That is, they buy low and sell high, or buy high and sell even higher. The flip side is called a bearish sentiment. This is when the trader believes that the stock price will go down. The nomenclature is due to the fact that bears attack in a high to low direction, standing upright on their rear limbs and then falling downward on their prey with their jaws and front claws. This sentiment causes the trading bears to jump in at a high price and exit at a low price in what is called short selling. Now, what is short selling? This is the second style of trading the market, and obviously the opposite of going long. It is the action of selling high and buying low. Now you might wonder, how can someone sell before they even buy the stock? How can we sell something we don't even own? Well, this is made possible by first borrowing the shares from their broker and selling them when the price is high. Then after that, when the price goes down, they rebuy the same number of shares that they had borrowed and sold earlier, and they return them to their broker again. This is called covering the position, and this is how they make their profit. Okay, so if you did not quite get it, let me simplify the concept through an example. Let's say stock XYZ is now at $5 per share, and the trader has a bearish sentiment that the stock price will go down due to bad news, for instance. The trader decides to short the stock. So he borrows 1,000 shares from his broker and sells them at $5 per share. So he effectively sells for $5,000. Okay? So now, in a couple of hours or days, the stock tanks to $4 per share, and our friend decides to cover his position. So he buys 1,000 shares at $4 per share, hence he pays $4,000 in this transaction. He returns the borrowed shares to his broker, and he comes out of his trade with a net profit of $1 per share, or $1,000 total. Great! Now let's summarize the different biases that a trader can have and the effect of different sentiments on bulls and bears. Number 1. A pure bullish trader will always go long, meaning he buys low, expecting the price to go up, then he sells high, making his profit. If he is already in a long position, and then the sentiment for the stock changes to bearish, and the stock starts tanking, he will sell his position, even at a loss, to avoid further losses caused by the dropping price. So, his bearish sentiment leads him to sell his position if he has one, or not to get into a stock if he feels bearish about it. A pure bearish trader, on the other hand, will always go short, meaning he borrows and sells at a high price, expecting the price to go lower. Then he buys or covers at a lower price, thus making his profit. If he is already in a short position and then the sentiment changes to bullish and the stock price starts running up, he will cover his position even at a loss to avoid further losses as the stock rallies upward. So, his bullish sentiment leads him to buy or cover his position if he already has one, or not to get into the stock if he feels bullish about it. Okay, so now it is obvious that the bulls and bears are always opposite in action, fighting each other to pull the stock price up or down. This is very healthy for the stock market, as this imbalance is what causes stock corrections when a stock is overextended in one direction or the other. Finally, let's discuss some of the advantages and disadvantages of going long and selling short. Well, let's start with the positives of going long. First, we need to realize that the overall stock market is designed to be long, and that the natural tendency of stocks is to go higher in price and value over time. So if you are long, you are going with the general designed market flaw. This brings us to the second advantage of going long, which is trading on the same side as most of the big boys. As you probably know, many big fund managers are long-based traders, and almost all investors are long-biased. So it is an advantage to trade with them as they have the big money to move the stock prices. The last benefit of going long is that the theoretical potential profit is infinite, while the maximum loss is 100%, which means losing all your money. You might say, how is losing 100% an advantage? Well, you will see how it is an advantage when we discuss the dangers of short selling. Okay, so now what about the drawbacks? The main drawback of going long is that stocks in general don't go up as fast as they go down in price. There are exceptions, of course, like we saw in the introductory lesson, for example. But generally speaking, stocks tank faster than they rise. Another problem might be that greed can cause you to buy at the very top of the stock price. And then if a panic sell-off happens, you can be trapped and not able to sell your shares until the stock price has significantly decreased in value. But to be honest, this is true in both long and short, so it can't be counted as a long disadvantage, but rather as a general issue to be wary of whether you are long or short. So just be careful. Now let's look at the pros and cons of selling short, and let's start with the upside. Number 1, the main advantage of selling short is that you can ride the backside of the move. What does that mean? It simply means that you don't have to anticipate as hard as longs have to. This is because short sellers generally jump into a stock which has already made a huge move and its news is all over the place. It has become excessively extended, so it is most likely to start pulling back and decreasing in price after the exaggerated move. That is when short sellers jump in, right after a supernova shows some signs of weakness and the sentiment starts shifting bearish on it. Contrast that to long traders who have to anticipate and jump on the stock while it is still running up, not knowing if they are buying at the very top or if it will continue to rally upwards. Another big advantage of short selling is that a lot of small cap companies are simply junk companies, and when they make their big moves, it is an exaggerated move without a strong fundamental reason. As a result, most of them eventually come right back down to where they started after the hype is over, giving short sellers a great opportunity to make some gains on the way down. Okay, now you're probably thinking, wow, short selling is awesome, right? Well, I'm afraid I have to disagree. While short selling can be appealing due to the reasons we mentioned earlier, we must first consider the dangers of short selling. The first and most important disadvantage of short selling is that the maximum profit you can make is 100%. And this is if you go short a stock, then it keeps tanking until it approaches zero. And you cover at the lowest point, which is probably not realistic. While on the flip side, and listen carefully now, the theoretical maximum amount you can lose is infinity. It is really scary. If you short a stock and it keeps going against you and increasing in price, then you can lose all your account and then also be in debt to your broker. This is where most short traders blow up their accounts. They become very stubborn, saying, "This is a junk company, it will eventually come down, I will just hold." And they keep holding and holding until they lose so much money and the pain becomes so great, causing them to finally cover their positions. And instead of losing a small amount, had they cut their losses early, now they have a hefty loss that can get them out of the game. Of course, this is the worst case scenario, but generally speaking, when a loss becomes big enough, the broker steps in and places what is called a buy-in, which brings us to the second drawback of shorting. A buy-in is when your broker steps in and covers your position without your permission or even your knowledge. When your broker sees that your losses have reached a dangerous level, they just want to make sure that they will be able to get the shares they had lent you back. So, what they do is buy you in at any price. They simply don't care about your plan. They just place a buy order in your account and buy the number of shares that you borrowed from them. This can be at the very top, incurring a huge loss to you. Another problem with short selling is the borrowing process itself. First, not all stocks are shortable. Some can't be shorted to start with. Second, even if the stock is shortable, it can be very difficult to borrow those shares because they are limited in quantity and many other short sellers want to borrow them at the same time. This is what differentiates different brokers. Some brokers are better than others in finding hard to borrow stocks and making them available for their traders. One last thing to mention is the counterpart to the long panic sell-off. It is called a short squeeze, where shorts race to cover their positions if the price goes up against them. This causes the stock price to go up further due to the high short seller demand on it, which in turn squeezes more shorts and so on. This is more common than the long panic sell-off, and it is much more dangerous. Okay, so let's look at an example to illustrate the difference between going long and selling short and to emphasize the amount of discipline needed if you are shorting a stock. Let us refer back to the stock DRYS that we looked in at an earlier lesson. Recall that it ran from approximately $4.8 to over $100 in 4 days. Now let's assume two traders decide to trade this stock at $10 per share. Both have a 100 grand account. Jane thinks that the stock is strong and decides to go long 1,000 shares at $10, while Tom thinks it is way overextended and should be coming down. He decides to short sell 1,000 shares at $10 per share. Now, what is the worst and best scenarios that can happen for each one of them? Let's assume DRYS dropped to 0.01. Jane loses approximately $10,000, which is 10% of her account, and Tom makes about $10,000. Now let's look at what actually happened. The stock rallied to $100 per share. So Jane made $90,000 and Tom lost 90 grand, which is 90% of his total account, although his initial investment was just $10,000, assuming he was not bought in earlier, of course. Now you get a feel of how dangerous short selling is and how important it is to be extremely disciplined if you short a stock. Now a final thought. You don't need to be either a pure bull or a pure bear. You can be bullish on some stocks and going long on them, and at the same time bearish on other stocks and short selling them. It's up to you. But my advice is choose one side first and master it, especially if you're a beginner. in order to avoid the confusion and mistakes of placing a buy instead of sell and vice versa. I myself am mostly a long bias trader. If you want to be a short seller, you need to be more disciplined in managing your risk, as one bad trade can literally wipe your account and get you out of the game, as we saw in the example. Alright, so now that you have a grasp of what bulls and bears are and what going long and selling short means, let's start to discuss the different trading styles and categories in the next section. Thank you and see you next time.